All right, guys, welcome back to AWMFX. Good morning, good afternoon, good evening, or good night, no matter where you are. So today I won't be touching about any skill, right? I think most of the skill I've already shared out with you guys. So today I'm gonna touch a bit on money management and some of the mistake or we call it, trading psychology. I felt that that is more important because no matter how good your skill is, if you cannot control yourself, it's down the drain, it's useless. All right, so it does not matter, really does not matter whether you just started watching my channel or previously you have watched other channel that teach you how to use indicator, either RSI, uh, uh, moving average, a Bollinger Band, or whatever it is. It doesn't matter, right? If it works, it works. Works well for you, then go ahead, right? So strategy is not that important. I believe every strategy works. It's just that how you approach it only, right? The most important is the money management and the trading psychology. So I'll talk about money management. For me, there are only two types of money management over here, right? So let me share. The first type is percentage. All right, percentage is actually very very simple. All right, uh, later I'm gonna share with you the second type is even better. So what happened was that the percentage is that let's assume you have a capital. All right, you have a capital of 1,000, okay, dollar, right? And you must know what is your risk in percent, right? This is a fixed risk percentage, right? Example here, maybe I'm gonna take 5%, right? Some of you might go for 10%, 20%. It's up to you. But if your account grow at bigger, or should I say you have bigger capital, your risk percentage should be smaller, right? So here, 5% is equivalent to $50. All right, so it's very very simple mathematic calculation, right? And I'm using XAUUSD because it's easy to calculate. So this has to be fixed, the risk over here. Then what happened is that every time you trade, you want to take the latest uh, capital you have, 5%. So later I'm going to give you an example. All right. So right now, it's easy to calculate. How do you calculate? Now you know your money risk is $50. Then of course you must know your stop loss. You can pre how's it pre-analyze your chart. You know your supply zone or you know your demand zone. Now let's assume it's a 20 pips stop loss. Right now you have a 20 pips stop loss. Okay, then what is the lot size you need to go in? So it's very easy actually. It's 20 divided by 50. All right, then your lot size will be 0.4. All right, it's that simple. So with using this formula, of course sometimes you need to add in 20 pips. You need to add in your, this one we call it the spread. All right, it depends on you, various spread. I cannot tell you anything. Maybe if your spread is add on is 5 pips, 25 pips, then it will be lesser, right? So by doing this, you know what is your risk, you can control, right? This is what we call as a control condition. Then let's assume you have this kind of trade, and your risk reward ratio is a 1 to 4, and you got your trade. All right, you have your take profit, you reach your take profit, so you gain $200, right? So once you gain the $200, now your new capital is 1,002. Agree with me? Because we just give an example. So you 1 to 4, 50 times 4 is 200. Then you have this figure. Now your risk, you still remain the same, 5%. All right, you don't change it. So your risk is still remain the same, 5%. So now your money risk has changed. Okay, by doing that, your money risk has changed. So 1,002 times 5%. it'll be $60. All right, it'll be $60. Then from there, that is how you keep growing your account. This is what we call it compounding, right? By doing this way. Even if you lose, let's assume that this trade you didn't win, right? You lose. Then what happened? Means that your capital now is 950. All right, 950. And your 5% of 950 is 47.50 cents. That's all. This is your new capital. This is your 5% risk. All right, equals to 5% risk. So hope you guys understand. This is a very simple calculation. By doing this way, actually you can preserve your capital very well, right? You can preserve your capital very well. So this is the first way of doing money management. All right. So now I'm gonna teach you the second way, the more rewarding way, but it's the most dangerous way. All right. I won't say that this is for the newbies. For the second method. The second method actually I call it very simple, kamikaze. All right. Kamikaze actually is a Japanese word, right? Last time when there is a world war, the Japanese, when they use kamikaze, means that it's like do or die. It's do or die method. But how do you use this kamikaze? All right. First, there are few rules, right? Of course, the first rule is that you must know very well, right? The rules. You must know very well your trading method. Right, you must know very well your trading method. You have back tested it 100 times, 200 times, 300 times, 400 times, again and again and again and again and again, right? And the most important is that to trade or to use this method, don't trade a lot of pairs. Okay, probably you only trade one pair to two pair, because you want to know or you want to familiar yourself with that pair only. All right, not other pair. You want to know what is happening with those pair, one or two pairs only. That's all. Okay, so this is the kamikaze rule, do or die. All right. So what is kamikaze? It's simple. Don't the third rule. Don't place huge capital. So what do I mean by don't place huge capital here is that for me, I think some of you guys, I mean a lot of Asian, or I believe a lot of Asians watching my videos. Some of you are African. I don't know where you're from. I don't know how well you're doing. But for me, I believe some of you are hoping to earn a lot of money with little capital. But first of all, you have to ask yourself, is that small capital that you put in is your life saving or not? If it is, please don't do that. Okay, so what do I mean by don't place huge capital? It means that every time you place your capital, you might place maybe let's assume it depends on your this one call it capability. Some may place it at $50, some may place it $100. All right, and each trade is based on this $50 and $100. That's all. Means that they do not place any stop loss on this. Yeah, some of you might criticize me right now. Why not placing stop loss? This is kamikaze. This is how you grow your account fast. All right, but it is not suitable for everyone. Right? So what do I mean is that $50, $100, you have to be very familiar with your strategy. You are super confident of what you are doing. Right? You know that every trade that you put in is a sure win. Yeah, I'm talking about showing right here. How? Do a lot of back testing, and of course, you only use one strategy. Out of the so many type of strategy that I taught you, right? You only use one strategy. Either example here is that you only use RBS. Even SBR also, you don't think about it. You don't look at it. Right? You only use RBS, RBS, RBS. Or some of you are comfortable with using QML. Just use QML, QML, QML all the way. Right? So this is how you use Kamikaze. Right? But not everyone is suitable. Like me, example for myself, I don't use this trade. I don't use this strategy. I use the percentage, but my percentage is higher, right? Because I know myself. Then for my mentor, if some of you know Nora, she used this strategy because she's very good with her trades, right? To her, she might put $300 as capital, but she can gain $118,000 within 8 days by using this way. Means that let's assume that they have she placed $300 and then it's 1 to 4, it has become 1,002, and 1,002 she will go all out. She will go all out, all out, all out, all the way until it reach her target. Okay, but one thing I learned about this strategy from her is that in your mindset, all right, in your mindset, you must think of one thing. If you lose, you only lose the $300, even though it has grown to maybe 40,000, 50,000. But if you lose, you only lose the first initial $300. You don't have to be heartbroken about it. All right, if you're not familiar with this Kamikaze strategy, don't use it. All right, you might stick to the percentage or increase your percentage, depends on yourself. All right, so now this is the only money management that I can teach you. All right, this is with stop loss, of course. The Kamikaze one, most of them they don't use stop loss, but they just go all out, all out. All right. So now we talk about the trading psychology a bit, right? Because I feel that it's the most important thing, right? Most of you must know. But of course, trading psychology comes with the mistakes, right? A lot of people, a lot of traders, they make a lot of mistakes, right? So I'll just summarize some of it. Hopefully, it will help. Of course, the first one is leaving a losing trade open, right? This does not goes well with Kamikaze rules, all right? The Kamikaze method. This applies on the first money management. So if you already have a losing trade, some of you cancel the stop loss, and end of the day you lose all your capital if you are putting a huge capital, because a lot of people will think about one thing: what goes up will comes down. It does not happen that way, right? All right, example is that if any of you are familiar with Brexit, all right, Brexit, the GBP pound, all right, the Great British Pound versus the USD, okay, it has dropped drastically, I think, for 3-4 years, and only recently, after 4 years, it comes back to the original position. So meaning, what does it mean? It means that, yeah, what goes down may comes up, all right, what goes up may comes down, but it takes very, very long time. You need to have a even bigger, huge capital to sustain the losses, and your psychology is torturing you for the 4 to 5 years. It might, I mean, if you're lucky. If not, it will just leave you losing all the way, and it will never come back. It might happen. All right, so do not leave a losing trade open. So the second mistake a lot of people do is the averaging down. All right, so what do I mean by averaging down? Now you have a losing trade. Example, you have a losing trade. So what happens is that you know you're at a negative, but you add in another trade. Okay, let's assume that the price we go to some of the example here. It's easier. So let's assume you're let me get all these things. Okay, just over here. Let's look at this trade over here. Let's assume that you make a sell over here, right? You make a sell over here, and the price came down. Well, you're very, very happy. All right, you're very happy. Then suddenly the price went up. All right, went up, and you're telling yourself, this is supposed to goes down, all right, this price supposed to goes down. And what you do is that you make another sell trade, hoping that when the price comes down, all right, you can go out with a zero loss, right? What happens is that the price keep going up, and you tell yourself it will come down, and you place another sell, another sell, another sell, until a condition, or should I say at a certain stage that your psychology, you cannot accept it, because the loss has gone very, very huge. Right, so this is what we call averaging down. Don't do that. Right, if it's lost, then just leave it alone. Right, there will be another opportunity. There will always be a lot of opportunity. All right, so averaging down the mistakes. So next, right, so next is the revenge trade. A lot of you like to do that. Sorry, revenge trade. Right. Of course, I'm telling you based on my experience. Even myself, I did that before. I'm not laughing any of you, because even myself, I did that before as when I started trading. All right. So every revenge trade, simple. You lost a trade, right? You close the trade. Then what happened? You double up your trade, right? Let's assume that the first trade you are placing a 0.5 lot size. All right, you lost a trade. Then what you do? You place one lot size. You think that you're gonna gain back what you have lost. Then in the end, you lost in that trade again. Then what you do? You maybe place two lot size. All right, some we call it the margin call method. I have done that, and I've lost even more money that you can't imagine. Right? Don't do that. Revenge trade. All right, leave it alone. If you lose, leave it alone. If you cannot accept it, close your computer. Then shut down your computer. Okay, go out, take some fresh air, come back, calm yourself down, look at the chart again, and see what you have missed out, what the chart has forget to tell you, or you didn't see. Right, reanalyze your chart. So that will be the revenge trade. Don't do that. All right, then the next one is losing out, scared of losing out. All right, simple, scared of losing out. All right, example, I give you multi example. Right, so what happens is that, let's assume we look at this trend over here, or this movement over here. So maybe at the time you saw your computer. Okay, maybe I'll place it even better like this. Right. Okay, maybe at the time you saw, you switch on your computer, and this is what you see. You might think that, oh my god, the price is shooting up very, very high. I must get in. Because I believe the price will keep going up. All right, because you're scared of losing out. This is what I mean by scared of losing out. So you might place a buy trade because you think that it's still going up. What happened next? It drops and drops. All right, and drops again until you cannot sustain. All right, you cannot sustain because you place your trade buy at the worst condition. You place yourself at the worst condition ever. So don't ever do that. If you already miss out one trade because you didn't see that trade, leave it alone. Leave it alone. That will be a lot of opportunity. All right, so this is a losing out. Don't ever do that. All right, then the last one, I believe some of you don't agree with me, but this is all based on my experience. All right, this is based on my experience. The last one is target. All right, I believe a lot of who should I say, a lot of mentors out there give you a fake hope, all right, false hope about target. So what do I mean by target? Right, target. Very simple. They might tell you one day you can gain 100 pips, one day you can gain 200 pips, one day you can gain 300 pips. So what do you, when once you have this kind of target, okay, for daily, you will think, I will definitely will get it. I will definitely will get it. So what will happen is that if you reach 100 pips and they will told you about you must get 200 pips per day, you will chase the trade. This is very wrong. Once you chase the trade, you give you an impression that you must get something. You are desperate for that. You are very, very desperate for that. All right. So the target can be pips. The target can be in dollar, or they might say that one day you can get $300. Then what happens if you only get $100? You're not satisfied. You want to get more. You want to get more. You want to get more. This is not trading. All right. Even for myself, sometimes I trade intraday. All right. I gain a few hundred. I mean, less than what I expected is okay. Because a gain for me is a gain. I don't care whether it's a big gain or small gain. And sometimes in the whole day, I don't even trade. Because I cannot see any opportunity to get myself in a advantageous position in the trade. So I don't do that. All right. Don't have a daily target. Right. You can get a monthly target. All right. But have your range bigger. Don't say that every month I want to get 2,000. I want to get 3,000. Right. And I want to get 4,000. So you give yourself a bigger range. All right. Like example, I want to get 1,000 to 5,000. So within there, you have a more comfortable position to yourself. All right. Then from there, you slowly, if your skill is getting better and better, slowly improve on your money management. All right, money management. Then you definitely will reach your target. Right? Don't give yourself too stringent target. All right. So I believe this is a few tips that I can share with you today. The video might be quite long. 20 something over minutes. Alright, so hopefully you guys pick up a few tips or tricks about trading. And I'm not going to share any much about strategy today. Reason is that because today is this week is the NFP, and the is, how should I say, the market is quite volatile. Wow, yeah, it's just moved 100 pips. See, every day there is an opportunity, 100 over pips. So it does not matter. I miss out this trade. So what? I can come back the other time, another time, right? So you must read your market well. You must know your enemy well, right? In order for you to slay, or no, in order for you to gain profit from the market. All right. So practice more, do a lot more back testing. And if you ask me, I will say that TradingView is a quite good platform for you to do your backtesting. Of course, if you subscribe to the Pro onwards, you can replay. Right, you can replay and then you can switch your time frame. All right, you can replay and switch your time frame and do your backtesting. Then, of course, there is a link in the description below. That is linked to my account. If you have not subscribed to TradingView, do subscribe using my link so that each of us can get, I believe it's $20, $10 or $20 bonus for both of us. All right, that's all for today. If you like the video, please give me a like and do subscribe. This week I'll be posting more videos because my country currently is in lockdown again, and I'm quite free at this moment, so every evening or every afternoon I can make at least 1 or 2 video and edit it. All right, so that's all for today. See you guys then.